In order to record a journal entry, we need some evidence that the transaction has occurred, whether it be a sales receipt, a check, a bill. It could be a physical document, or it could be an electronic document. So once we have the evidence of the transaction, then we can look to journalizing the transaction. The general journal is considered the book of original entry, and the reason for that is that it is the first place in an accounting system where the transaction is recorded or appears. Right, so the recording process discloses the complete effects of a transaction, provides a chronological order of transactions, and helps prevent or locate errors because the debit and credits amounts can easily be compared. Right, so what we're going to see in this slide is we're going to see some examples of general journal transactions. A few points that I want to make here. Under the date column, you'd have first of all, if you're starting the beginning of a calendar year, you'd put the year, followed by the month and the day of the month. If you're working within a month, you put the month, the day of the month, and then you do not have to repeat the month as long as all the transactions are occurring within that month. You would just put the date within that month. The accounts that are debited are always listed first, and there could be more than one account that is debited. The accounts that are credited are listed under the amounts that are debited, and the titles of those accounts are slightly indented under the titles of the accounts that have been debited. The reference column that you see, we will not be using for the purposes of this course. That is for posting in a manual system. Also, you will notice that the debit column is on the left and the credit column is on the right, which is consistent with what we saw with the T accounts, where the debit is to the left side of the T account, the credit is on the right. Alright, so the first transaction on September 1st, stockholders invested $15,000 in cash in the corporation in exchange for shares of stock. Alright, so we know that cash is coming in. Cash is an asset. The way we increase cash or an asset is we debit the account. The shareholders are buying ownership, so that they are buying stock. So common stock is an equity account. The way we increase an equity account is to credit it. So we'll debit cash for $15,000 and credit common stock for $15,000. Next transaction, SoftBite purchased computer equipment for $7,000 cash. So what we have here is two assets. We have equipment, which is an asset, which is going up, and another asset, cash, which is going down by $7,000. So equipment we will debit for $7,000, and cash we will credit for $7,000. All right, on July 1st, this is what is known as a compound entry. And the reason it's called a compound entry is that in this case we have two accounts that are credited. So on July 1st, Butler Company purchases a delivery truck costing $14,000. It pays $8,000 cash now and agrees to pay the remaining $6,000 on account. All right, so here's a key phrase here. Agrees to pay the remaining $6,000 on account. We know that they owe the $6,000, and when we see on account, that tells us accounts payable. So we're going to debit equipment for the full cost of the delivery truck of $14,000. We credit cash for the $8,000, so cash is going out for $8,000. Then we credit accounts payable for $6,000 because Butler will pay that in the future. And if you notice, the debits equal the credits, and in a journal entry we have to make sure that the debits are always equal to the credits. What we have here is an illustration of the general ledger. So the general ledger contains an account for each account that appears on the financial statements, and of course those accounts would have been used in recording journal entries. The chart of accounts, if you will, is a table of contents for the general ledger. And as you will notice, there is a number associated with each ledger account. This is really important when it comes to the traditional posting that is done by hand, but also that is now done via computer. It is something that we are not going to be doing in this course, but just know that they exist, and the reason they exist. One thing I will point out to you that you're not going to deal with at all in this course, if you go under stockholders equity, you see the account number 350, income summary. That is something that we will not use. If you're an accounting major, you will go through the closing entries, and income summary is used in the closing entries. So what we have here is an illustration of how we would go about recording a transaction. So if we look at this, it says on October 1st, C.R. Bird invests $10,000 cash in an advertising company to be known as Pioneer Advertising Inc. So we have to first think about this. We have to think about what accounts are going to be involved and how are they going to be impacted. So if cash is coming into the business, we know cash is going to go up. But it's saying that they are investing. Investing says that they want to buy stock. So if you look at the equation analysis, cash will increase by $10,000 and common stock will increase by $10,000. So now we need to translate that into debits and credits. Cash is an asset. In order to increase an asset, we need to debit it. So we know we'll debit cash. Common stock is an equity account. We know in order to increase common stock or an equity account, we have to credit the account. So now we can prepare the journal entry. On October 1st, we debit cash for $10,000, and then we credit common stock for $10,000. In the reference columns, they did put the postings. Don't worry about that. But now let's go down to the T accounts. So we have the T account cash. There's no beginning balance in there because it's a startup company. But we need to post the debit to cash of $10,000. And notice they put the date there. That's important. So it enables you to be able to keep track of your postings in the event that there's an error that's been made. And then you see the posting of a credit to the common stock account. The next transaction on October 1st, Pioneer purchases office equipment costing $5,000 by signing a 3-month 12% note payable. So this isn't an accounts payable. If it was an accounts payable, it would say on account. It's a note. So they are going to sign an agreement that says they will repay the $5,000 at the end of 3 months plus interest at a rate of 12%. Equipment is an asset. It's going to go up, and notes payable is a liability. That will go up as well. So as you can see, we're going to debit equipment for $5,000 and credit notes payable for $5,000. And then you can see the posting. So the equipment account gets a debit posting of $5,000, notes payable. We post a credit of $5,000. And once again, you notice the debits and credits are equal. All right. The next transaction, on October 2nd, Pioneer receives $1,200 cash advance from Arnox, a client for advertising services that are expected to be completed by December 31st. So this is what's happening. Pioneer is getting money up front for something they haven't done yet. So they owe a service to Arnox. So let's think about what's happening here. They're getting cash. Cash is going to increase by $1,200. Then they owe Knox a service. So now we have a new liability account called unearned service revenue. So we're going to increase cash by $1,200, and we're going to increase unearned service revenue by $1,200. So if you go down the journal entry, once again we put in the date. We record the debit to cash of $1,200 and record the credit to unearned service revenue, $1,200. One thing I forgot to mention to you is in this illustration that I'm going through, they put explanations of the journal entries underneath the entry. That is not necessary for you to do. That was really important in terms of a manual system. Granted, we are doing this manually, but I do not require it. So now let's go to the posting. Look at the cash account. We see the $10,000 that we posted as a result of the October 1st transaction. Now we're going to post another debit to the cash account of $1,200. And then we post a $1,200 credit to unearned service revenue. Right, on October 3rd, Pioneer pays office rent for October in cash, $900. All right, so let's think about this. Pays, that is a key. That tells us that cash is going out. And it says pays in cash, so therefore we know cash is going to go down. And if a debit increases cash, we know that a credit will decrease cash. Right, so they're paying office rent. That would be an expense. So we're using a new type of an account now, rent expense. And the way to increase the rent any expense account is to debit the account. So in our journal entry, we're debiting rent expense for $900 and crediting cash for $900. We go to the T accounts and do the posting. So this time on October 3rd, we're posting a $900 credit to the cash account. And then we post a $900 debit to rent expense. On October 4th, Pioneer pays $600 for a one-year insurance policy that will expire next year on September 30th. This is what's happening here. Pioneer is purchasing the future benefit that they will get from the insurance coverage. So what we have here is an asset. And as you will notice in looking at the journal entry, the asset is called prepaid insurance. So what we have here is we have this asset, prepaid insurance, going up and cash going down by the same amount. So that word pays or paid always tells us that cash is going out. So we're going to debit prepaid insurance for $600 and credit cash for $600. We go back to the posting now on the T accounts. Now we're going to post a $600 credit to cash, and we have a posting of a $600 debit balance to prepaid insurance. And if you will notice so far, there's a lot of activity in the cash account, and that is something that you will see throughout not only this example, but also problems that you will be doing. The next transaction occurs on October 5th. Pioneer purchases an estimated 3-month supply of advertising materials on account, key phrase, from Aero Supply for $2,500. So they're purchasing supplies. Supplies is an asset. Since supplies is an asset, it's going to go up. In order to increase an asset, we're going to debit the account. It says they're purchasing on account, which means they haven't paid for those supplies yet. So that means they're incurring a liability, and that liability account is accounts payable. So in the journal entry, we're debiting supplies, crediting accounts payable for $2,500. Then we go to the posting. We post the debit to supplies of $2,500, and then the credit to accounts payable of $2,500. All right, now on October 9th, Pioneer hires 4 employees to begin work on October 15th. Each employee is to receive a weekly salary of $500 for a 5-day work week payable every 2 weeks. First payment is made on October 26th. There is no journal entry here. And the reason for that is all they've done is hired the employees. The employees have not provided a service yet. If we go to October 20th, Pioneer's Board of Directors declares and pays a $500 cash dividend to stockholders. So, pays $500 cash, we know that's going down. And then dividends will cause stockholders' equity to go down, namely retained earnings. So, to record that journal entry, we're going to debit dividends. And if you remember the first part of the lecture, in order to increase a dividend account, we will debit that, which has the effect of reducing retained earnings, and we credit cash for $500. Now we go and we do the posting. We go back to the cash account. And now we're posting another credit to the cash account of $500 and posting a debit to the dividends account of $500. On October 26th, Pioneer pays employees salaries of $4,000 and pays them in cash. So, pays them in cash tells us that $4,000 will be going out, so that'll cause a decrease in cash. And if they're paying employees salaries, they're paying them for services that the employees provided in order for the company to generate revenue. So we have salaries and wages expense, which will have the effect of reducing stockholders' equity, once again, namely retained earnings. So in terms of a journal entry, we will debit salaries and wages expense for $4,000 and credit cash for $4,000. In posting, we're going to post a credit to the cash of $4,000 and post a debit to salaries and wages expenses of $4,000. The final entry. On October 31st, Pioneer receives $10,000 in cash from Copa Company for advertising services performed in October. So this is what happens. The services were performed and cash was received. So for receiving cash, cash is going to go up. So we're going to debit the cash account for $10,000. Service revenue, as we saw in the first half of the lecture, will cause retained earnings to go up, and the way to increase retained earnings is with a credit. And we saw that the normal balance of service revenue is a credit, so we will credit service revenue for $10,000. So we post the $4,000 credit to cash. We post the $10,000 debit to the cash account, and then we post the $10,000 credit to the service revenue account. So what we've done is we have recorded in the general journal and posted to the T accounts all the transactions for the month of October. The next step is to prepare the trial balance. And in the trial balance, what we have is all of the final account balances for each of the accounts that we use in the journal entries. What we have to ensure is that the debits are equal to the credits. So for example, in the cash account, in order to come up with the final balances, what we needed to have done is to add up all the debits for the cash account, add up all the credits. subtract the credits from the debits, and that would have left us with a debit balance of $15,200. There is no way that there should be a credit balance in cash. Once we've come up with the final balances, then we prepare the trial balance. A few things I want to mention about the trial balance. First of all, it is not a financial statement. That's number one. And it has a debit and a credit column. The financial statements do not have debits and credits. It is not unusual for students to confuse the trial balance with the balance sheet, but keep in mind they are not the same. The next thing that is important is the order in which the accounts are listed in the trial balance. We first start off with the assets. The assets are listed in the order of liquidity. When we talk about liquidity, we're talking about the order in which they would convert to cash. So obviously cash is the most liquid of the assets. Usually we'll have an accounts receivable account. That would come right after cash, because the assumption is that the company will be receiving cash, so the accounts receivable will convert to cash. Cash, supplies, and prepaid insurance are all current assets, which means they'll convert to cash within 1 year or less. Equipment is known as a long-term or a fixed asset. This is an asset that has been purchased and will provide service to the company to operate for the unforeseeable future. After that, we list our liabilities. Notes payable is listed first in this case, and that would happen when the note payable is current. In other words, that means it will be paid within the year. If it was not, then accounts payable will be listed first. Accounts payable and unserviced revenue are always considered current liabilities because they must be satisfied within the year. Once we have listed all the liabilities, then we go to the equity accounts. In this case, we have common stock. If this was not a startup company, we would have had a balance in the retained earnings account, in which case retained earnings would have been listed right under common stock. After common stock in this case is dividends, but if we had retained earnings, it would be retained earnings, then dividends, and as you know, dividends has a debit balance. Next comes our revenue account balances, and then our expenses. And as you can see, the debits and credits are equal, which means we have maintained the equality of our accounting equation, but it doesn't mean that everything's right with the world, because there are some limitations of the trial balance. And the next slide will list them. And here are the limitations. We can have debits equal credits, but we may have not journalized a transaction, or there may have been a journal entry that we recorded but we never posted, or we posted a journal entry twice, or we recorded or journalized a transaction at incorrect amounts. And then offsetting errors can be made in recording the amount of the transaction. So the point is that the trial balance is not, the equality of the trial balance is not a guarantee that there are no errors. So what I will have on our read and review is the assignments that you should do that go along with this lecture.